Tobias Levkovich is with us. I'm pleased to say Chief US equity strategist at Citi. Tobias, sticking with us through this closing bell. What do you make of what we're seeing at these, as we head towards earnings, as we look towards economic data this week as well, but we are at these lofty valuations? Is sentiment nervous at the moment, would you say?
I think sentiment is pretty buoyant at the moment. I think investors are pretty happy. They're forecasting strong economic growth, not just for the first quarter that just ended, but also the second and third quarters, particularly if we get stimulus or incremental stimulus. So investors are not particularly nervous. They're actually pretty excited. They're more nervous about leaving their money in cash, which is why you get this concept of TINA, or there is no alternative. Our concerns is they're too optimistic about the earnings outcomes, and valuations are being stretched. So you kind of have this kind of shakier reasons to buy at these levels.
I'm curious, though. I mean, so far, most of the earnings not only have met the bar that the street was looking for, but overall they've been pretty good and on even just an absolute level in terms of revenue growth, margin expansion here. But there seems to be this idea here that you just really have to knock it out of the park for investors to sort of be satisfied at current valuations. Is that an issue?
So I think you kind of hit the nail on the head, Romain, in the sense that if you think about what is the market already pricing, we look at this and we think the market's already pricing about $190 in earnings this year, and the current consensus bottomed up from the analysts about 174 for the S&P 500. So there is this expectation that you have to do that much better, as you said, hit the ball out of the park. And what we're seeing to some degree in the first quarter is companies that beat the numbers maybe get up a little bit. Companies that hit the number slip a bit, and anybody who disappoints actually gets smushed. It's a technical term.
Smushed. We love it. Tobias, are we not bullish enough? Are we too bearish? On aggregate, we're hearing companies are beating earnings by 26% and beating the expectations by 11%.
Look, I think that companies have done a really good job of under promise, over deliver. This idea of constantly talk down, be conservative, these wonderful words like guarded optimism. I think everyone knows the economy is going to be much stronger at this stage. The combination of vaccination, easy comparisons, reopening trades, all these kind of things suggest the economy is going to be strong. And I think the critical issue over the next 2-3 quarters is, can you really get it in the margins? Can companies be able to offset some of the cost increases they're experiencing? Either it's in input costs like commodities, transportation, fuel, et cetera, or even now starting to come into the labor side. Are they able to put in pricing that offsets this, or does it lag a little bit? Maybe it shows up more in 2022 than the latter part of 2021.